Good morning and welcome to the CT Private Equity Trust PLC Q2 NAV update investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Hamish Mayer, Fund Manager. Good morning.
Good morning, ladies and gentlemen, and welcome to this presentation on CT Private Equity Trust. It's our interim results presentation, the results for the 6 months to the end of June. First of all, I should say this is the first time we've done a presentation under our new name. We were BMO Private Equity Trust until the 4th of July, and we've now changed our name to CT to reflect the acquisition of our management company by Columbia Threadneedle last November. So CT, just in case you're wondering, stands for Columbia Threadneedle. This is actually the fourth name we've had as a company, although it's been the same management team, and I've managed the company since it started more than 23 years ago. I've got a number of slides here which I will take you through, and then we will open up the discussion for questions. I'll go through these slides reasonably quickly. Some of them I will spend more time on, but if we just start by looking at the summary of the interim results, the second quarter's performance. So the NAV per share in the 3 months to June was up 3.9% on a NAV total return basis, which gives a return for the half year of 4.3%. We've announced a new dividend, 6.31 pence, which will be paid at the end of October. So this gives a prospective yield of over 5% based on the period end share price, and it's a bit lower now than it was then, so it's even better. A couple of highlights, and I'll talk about these in a minute. We exited our co-investment in the clean room consumables company Stacks, returning over 6 times money and 80% IRR, and that money was received during May. The co-investment component of the portfolio, an important part of our offering, is at 43.3%. We continue to make good progress, notwithstanding everything that's going on in the world. The NAV has grown nicely in the first half, and you can see the progress over the first 2 quarters and how that compares both with the last 12 months and with the whole of 2021, which of course was a very strong year. If we move on, we made a number of new investments during the second quarter. 2 new fund commitments, one to a new fund called Northern Gritstone, which is quite an unusual proposition. It's a new investment company that will hold companies that have spun out of universities in the north of England, specifically from the universities of Manchester, Leeds and Sheffield. It also has flexibility to do some other growth equity and venture investments in the north of England. So why have we done this? Well, we think there's good potential to make excellent returns there. What probably most of you aren't aware of is that one of my external responsibilities is that I chair the investment committee of Old College Capital, which is the Edinburgh University spin-out vehicle. So I have seen directly what is possible from successful university spin-outs, and Northern Gritstone in some ways is a larger version of this, and it's something that it's one of the, well, it's the only one that's actually accessible easily to external investors. So 5 million commitment there. Secondly, we invested or committed $10 million to HG Saturn III. So this is run by HG, who are a very long-standing private equity firm who focus on the upper mid-market in software and services companies. They have an outstanding record. We have had limited involvement with HG over the years, but we've decided to put some money into this fund, having met the team and analysed the record. We think they've got a unique and consistently successful style, which we fervently hope they will maintain in this new fund. We've also made one secondary purchase. Now it's a sort of rather close to home deal where essentially the trust has bought the remaining element of the portfolio from our oldest limited partnership, F&C European Capital Partners LP. That fund has been going since 2007. The investors are quite correctly looking for a liquidity solution, which the trust has been able to provide to them. That allows them to cash out, but it also allows us to invest at quite a competitive price. Essentially, we paid about 50% of NAV, which is actually the market price for that type of tail end position. But at that price, we should make an excellent return going forward over the next few years. The investors in that, the original investors in that fund, don't have the appetite to continue for several more years, whereas with our permanent capital structure, we can do precisely that. And lastly, we've made two new co-investments, Refine and Leader 96. And I've got a couple of slides on those later on, so I'll maybe just go into more detail then. Moving on, just to put the current NAV in context, I showed you the longer term picture. You can see steady improvement in NAV and cumulatively paying very attractive dividends. The current dividend policy of paying out 1% of the average of the last 4 quarters NAV was introduced in 2012, so we've had it for 10 years. It is a highly predictable policy because at any given point in time there is only one missing piece of information, which is the latest NAV. And should that calculation lead to a lower number than the previous dividend, then we maintain the previous dividend. So in other words, it's an upwards only policy. And that has proved to be popular and attractive to our investors. So as mentioned, we've got another dividend which will be paid at the end of October, 6.31 pence per share. Over the last 10 years, this has resulted in average dividend yield of 4.7%, or as I mentioned a moment ago, the current prospective yield is quite a bit higher than that. This is the NAV total return and share price total return and the equivalent from the stock market over the long term, the whole 23 years since the company started. And you can see that we have greatly outperformed the stock market. This is why one invests in private equity. You should, because you're taking the extra risk, receive a premium return. And in round numbers, we've had double the rate of return that you would have achieved in the stock market over that period, and have made 3 or 4 times the capital gain. So private equity investment over the long term does pay off, and we are the living proof of that. This is just another way of looking at performance, breaking it down over 1, 3, and 5 years. Again, you can see some pretty strong numbers there. Outstanding commitments, it's something that some people like to track quite closely. This is where we make commitments to private equity funds in advance, and we do need to do that in order to efficiently deploy our balance sheet. We are at 179 million at the end of June. This is not a very high level in relation to the size of the company, nor to its historic average. Now, those of you looking at this chart closely will see that we used to run with much higher level of commitments prior to the global financial crisis. And it was a deliberate policy after that to manage that down to a lower level. Although it is fair to say we did not have a problem in terms of meeting our commitments, even when they were much, much higher than they are now. So that's just for information. In terms of debt, we have a little bit of net debt, 14.6 million at the end of June. We also carry a sort of cash balance, so that's the net debt. We need some cash because we always have some investments that are pending, about to happen. We've got plenty of our borrowing facility. About 3/4 of our borrowing facility is still available should we need to draw on it to make new investments. So we're well placed and well funded for the present and for the immediate future. In terms of investments made in 2022 to date. This is the complete list. So I'm not going to run through all of these individually, but you can see that there's quite a wide range of different funds and co-investments. I'm going to talk about the co-investments individually in a minute, but the funds are in different parts of Europe and North America, and they're all mid-market funds, but they have slightly different specialisms within the mid-market. And this is deliberate, that we maintain a well-diversified portfolio. I'll probably say this more than once, but one of the strengths of a company like this is that it has a naturally high degree of diversification. Private equity is a naturally risky asset class, and I've been doing it for over 20 years, nearly 30 years, and there's only one effective way of reducing that naturally high risk, and that is by running a well-diversified portfolio. So we aim to provide strong private equity returns at only moderate levels of risk, and the way we do that is by maintaining a high degree of diversification. If we look on the next page, I'm just going to run through a couple of the highlights of the recent co-investments. These, the first 2 or 3 were done earlier in the year, and I'll sort of speak briefly about them. Aurora Payment Solutions. This is a payments company in America. It's based in Texas. Their customer base are essentially sort of small merchants, hotels and hospitality outlets in the US. Excuse me. And one of the main attractions of this deal was that, first of all, it's led by Corsair Capital, who specialize in financial services investments and who we have known for a number of years. But secondly, the chief executive of this business has built up and sold successfully a very similar business a few years ago. And so this is, this is his second project, if you like, and we think we should be able to make a very good return off this over the next few years. The next one is completely different. This is Beau Mackie. This is a restaurant chain in northern Italy. It is a fusion cuisine, so it's a mixture of Japanese and Brazilian food, so-called sushi samba. I think there is actually a chain in Britain called Sushi Samba. This one is actually called Beau Mackie. And the plan here is a rollout from 9 restaurants to 24 restaurants. This has proved to be quite a robust defensive business, even through lockdown, surprisingly. And the deal here is led by Augens, who are an Italian private equity firm with whom we're already co-invested through San Siro, and for whom we have a good regard. Again, we're aiming for a good attractive return here over about the next 4 years. Perfect Image, different again. This is a IT services company. It provides transition to the cloud and cyber security, essentially to small and medium-sized enterprises across the UK. This is a deal led by Chiltern Capital, which is a firm that we've known for a number of years. And again, we're aiming to make more than 3 times our money here. It's not an expensive deal. It's quite a small company, and therefore we've got in at a reasonably low price. And if they come anywhere near implementing their business plan, then we should be able to sell this on at a significantly better multiple within a few years. And even if we maintain the current multiple, we should still make 3 times money or so. So let me just go on to the next one. This is one of the new ones this quarter. It's called Leader 96. So this is an e-bike assembler. So essentially electric bikes, which is a strongly growing market. The company is based in Bulgaria. So the Rohatyn Group that we're partnering with here are specialists in Eastern Europe. But don't sort of panic just because it's based in Bulgaria. Most of what it sells is sold into Western Europe, Germany, France, increasingly the UK. What we are seeing is that the penetration of e-bikes is quite substantial in Germany and the Netherlands. It's much less so in places like the UK, Spain, and to some degree France. But the market is growing quite rapidly. It's growing at sort of double digits over the next several years. Probably quite a lot of you have got an e-bike. I actually don't have one yet. That's just because I haven't got around to buying one. But there are lots of societal trends that are favouring e-bikes, and they have a lot of advantages over ordinary bikes. Indeed, this company started off as an ordinary bike manufacturer, and it's now switched over almost completely to e-bikes. So again, we expect that this trend will persist. It's not directly dependent on what's going on in the economy, and we're looking to make 4 times our money over the next 5 years or so. We've already done well with our other investments that we have, led by the Rohatyn Group, so we're confident about this. The next one is Refine, a totally different company. Again, this is led by Kester Capital, another emerging manager that we have backed. Now, Refine essentially provides audit services on good manufacturing practice for the pharmaceutical sector, mainly generic drugs manufacturers. So what they do is they go in and provide a report which gives customers or potential customers of a pharmaceutical company a detailed and authoritative report about their capabilities of manufacturing these drugs, to the appropriate regulatory standards. Now, this is a strongly growing market. You won't be surprised to learn that regulation is constantly increasing, and also the number of products, drugs that are on the market is sort of growing rapidly in tandem with growth in healthcare generally. And so there are very strong market growth characteristics here. And this is a relatively small company, but it is a market leader, and it's growing rapidly into and with this market. So we're aiming to make 3.7 times, nearly 40% over the next 4 years. Now, I should say all these numbers I've said in terms of aiming to make, I mean, these are targets. These aren't guarantees. This is private equity. I'm sure some of them will actually achieve these projections and exceed them, but not all of them. But our long-term track record would suggest that there's a good chance that these numbers will be fulfilled. If we look onto the next page, this is a different company. Again, it's actually based in Canada, this one. It's led by the Canadian private equity firm Peloton Capital, and it's essentially a chain of dental practices. So some of you will be aware of the chains of dentists that exist in the UK. Well, the same thing happens in Canada. And this is a deal where Peloton have actually been in the deal for 3 years, and they're recapitalizing it, and we're coming in. So they have the full visibility and knowledge of the dynamics of this business and the capability of its management team, which does tend to de-risk the proposition substantially. And this is all about essentially buying dental practices and building them into this large chain. There are lots of buying synergies and other economies that make the sum of the parts much greater than the aggregation of the companies is much more valuable than just adding up all the individual ones. So again, we're aiming for a good return here over the next few years. This was sourced by our Canadian director. We have a director in Canada who knows that market in a lot of detail and is close to Peloton Capital. So those are the recent co-investments. So the common factor here is that they are They are well priced, they're attractive price. They are well led by experienced private equity lead managers. They meet our target requirements in terms of IRR. We won't deal unless we're sure we can do a net IRR of 25% minimum. And they're all quite different, so they're not interlinked to each other. They're playing different economic and societal trends. So just moving on to look at the realizations in 2022 to date. I'm not going to go through all of these, but if you look on the right-hand side, you can see the total value to paid in capital, in other words, the money multiple, and the IRR, the internal rate of return. And in just about every case, these are really good numbers. And where there's one that says not disclosed, and you can take it from me that it's also a very good number. It's just that we're not allowed to mention it because it is so good. So despite everything that's going on in the world, private equity firms are still selling their companies and making really good, strong returns. And the premium to the latest valuation has been maintained. It's up in the sort of 30% plus range, 35% or so. So we have been expecting to see a slowdown. Now, I'm not saying that won't happen, but in terms of the first half of the year, there's not a lot of evidence of that when one looks at the exits that have already been achieved. So the portfolio is also being rejuvenated. It's not just the co-investments that I have already mentioned, but there are lots of other individual deals being done by the funds in our portfolio. And again, these are in a very wide range of different sectors and geographies and led by different managers. But all these managers are people that we know and trust, and in many cases have invested with for, a long number of years. So you can see, looking at that, there's quite a lot of healthcare and information technology businesses, but not all of them. There are, as we've just looked at, more sort of conventional business models like the restaurant chain that we've just talked about. So this next chart just shows you the long-term picture of distributions and drawdowns. I mean, you can see these large dark blue blocks. Recently, we did go through a exit boom during 2001. Partly that was because there wasn't much, not 2021, sorry. Partly that was because there wasn't much going on in 2020 for obvious reasons. So there's an element of catch up there. But although we were expecting a bit of a kind of slowdown in this year, it hasn't actually slowed down that much. It's still, if you look at that first half of, it actually says H2, it should say H1 2022 blue bar. It actually compares very well with the previous one. So it's actually it's a strong number compared to the historic record. In fact, I think in the first half of this year, we have had more realizations than we had in the whole of 2019, which was the last full year before the pandemic. So essentially, our investment partners are doing well in realizing their investments. So moving on, largest underlying holdings. This changes a bit from quarter to quarter. It hasn't changed radically, so some of you will recognize this. The largest company is an electric components company, Sigma, based in the States, which has been doing quite well. They've had to sort of look closely at their supply chain with all that's been going on in the world post-COVID, but that is under control. And the lead manager, Argand, I think, are still aiming to exit this either later this year or early next year. There are two other companies here, TWMA, in fact, there's three, including Ashtead, which are led by Buckthorn and which are involved in the sort of energy sector. They have actually done quite nicely recently. These are essentially beneficiaries of the high oil price. TWMA cleans up oil rig drill cuttings, cleans them up, and it's good for the environment. The contracts are influenced by the oil price, obviously, so they have seen a lot of interest and new contracts recently. Coretrax is also involved in this area in a different way. It does wellbore cleanup and plug and abandonment services. So there's an element of counter-cyclicality there, in that it is a sort of long-term play on decommissioning of redundant oil fields in the North Sea and other places. But its services are also required when you're producing oil. So that is also doing very well. There's a good sort of tailwind there. The fourth investment here is our funeral homes company in northern Italy, San Siro. So this is doing well. They have also acquired a number of crematoria, which is unusual for a funeral homes company to use to own these, which should improve the overall value of the business when it comes time to exit. So that one's going really well. Ashtead is now it's actually a listed company now. We've still got some shares in the limited partnership. Plan would be for those to be sold down gradually. This is it rents out equipment that's used for monitoring subsea installations. So it's not just the oil industry. It's linked to wind farms, which, if any of you have been in the north of Scotland recently, you'll see lots of them off the coast. And that business is also doing well. Sixth one is Weirdfish, our clothing company. I think the last time I did this presentation, I gave you a hint it might be sold. Well, in fact, that deal fell through, sadly. So we're going to be holding this for a bit longer. Trading has been a bit tougher this year than last year. It benefited from the burst of e-commerce during COVID, and they're now suffering a bit from that, having declined from the highs of last year. But it's still a strong company, and we will ultimately realize it at a decent price. Seventh one here is Ambio, active pharmaceutical ingredient company based in the US and China, led by MVM, who are life science specialists. The plan was to try and do an IPO of this in Hong Kong. I think the latest plan is probably not to do that, but to find an exit in another route. Just to put in context, we already sold 3/4 of this. So this, although it's quite a large holding, is essentially a rump position. So I think when it's sold, it will be a perfectly reasonable outcome. And then we've got our pet shop chain, our remaining pet shop chain. We used to have two, but we've got one now, British one, Jollyes, which is trading well. It's the second largest chain after Pets at Home, and that's led by Kester Capital. Aurora Payments I've already talked to you about. And then the 10th position is Accuvein. So this is a company you may remember I explained about it before. It basically allows, it's a piece of equipment that allows nurses and doctors to inject people more accurately, find their veins using an infrared enabled technology. That has been a bit slower because during COVID, it was difficult for their sales reps to sell any of the product because they weren't allowed into the hospitals. That has now improved and it's now catching up. So again, very wide variety of different types of company, different lead managers, different geographies, different economic drivers. But each of these has a distinct investment thesis and, are largely exposed to, either a business or economic growth trend that we expect to persist for some time. Just looking at the diversification, I mentioned this earlier on. I told you I'd come back to this. So we are well diversified by geography, although we do have a significant weighting in the UK. Now, this distinguishes us from a number of our peers, most of whom have hardly got anything in the UK. But we have nearly half. Now, why is that? Well, we're obviously based in the UK, but it is also the deepest and most sophisticated private equity market in Europe. And we are essentially a European portfolio, Most of the rest is invested in continental Europe in a range of different markets, although we do have a significant element at 15% in the USA, which is indeed the world's largest and deepest, longest established private equity market, in which we have a number of good links and connections, which we use when finding investments. So geographical diversification is important, but also diversification by vintage year, the year in which the investments were made. We tend to track how much of the portfolio is over 3 or 4 years, because the general investment thesis at the level of an individual company is for a 4-year hold. Sometimes it's longer, occasionally it's shorter, but after about 3 years, if things have gone according to plan, it is becoming a candidate for realization. And so tracking the component that is more than 3 years old is a way of if you like, tracking your stock of pending realizations. So we still have, nearly 2/3 of the company is more than 3 years old, and therefore there's always something that's coming through and ready to be sold, which means that even during quite, subdued conditions, we will always have a decent flow of realizations. Weighted average valuation is enterprise value to EBITDA or to cash flow, 12.2 times. This hasn't changed since the beginning of the year. The components will have changed, but the actual overall number hasn't changed, which compares with an average of 8.2 times the entry. That entry multiple would have been a few years ago. And the debt is 2.9 times on debt to EBITDA, which is quite a modest amount of gearing. Obviously, that is an aggregate number, so that includes deals that have just been done and also companies that have been in the portfolio for years and which have substantially de-geared. The good thing about this valuation is it means we don't have to wait for somebody to come along and offer a really high price to get an exit. There are hundreds of companies in this portfolio, lots of people interested in buying them, including other larger private equity funds, and they can normally offer a price which is very acceptable to the smaller funds or to the lead managers or to us, and it makes exits a good deal for everybody. So this is the diversification by sector. You can see it's quite a lot of information on this slide, but things I'll point out, apart from the fact it's well spread across sectors, is that we do have significant exposure in information technology and healthcare, which together account for nearly half the portfolio. And that is where a lot of growth is. And we have seen a good appetite for both these sectors sustained right the way through the pandemic and out the other side. Digitalization of the economy, plus also the expanding remit of healthcare, if you like, provides very strong sort of secular growth underpinning for these sectors, and hence they prove attractive to private equity, which is ultimately is the ultimate sort of long-term investment asset class. But we've got good spread in other sectors as well. So just moving on the conclusion and outlook, just to wrap up, we have had a good start to 2022. I've spoken to you before about how resilient the portfolio was through the pandemic, and it has been with previous economic crises, of which there have been a few in the life of this company. It has come through well on the other side. So far, we are holding up well. In fact, we've actually grown. We've got plenty of firepower for new investments, funded both by realizations but also by our revolving credit facility, and we are continuing to invest. We have had quiet periods for making new investment. I mean, we did have at the beginning of the pandemic for pretty obvious reasons, and we have had slower periods back in the global financial crisis. But there is always something. There are always some deals being done, and there are always opportunities. And sometimes when you go through more challenging periods, there can be real value. We see perennial value in the lower mid-market, so there will always be some new deals being done. The co-investment component, we're aiming for that to be about 50% of the portfolio, so at 43%, it's a bit below that, but we're always selling things, so it's a balance between the pace of realization and the pace of new investments. But the primary thing that determines co-investment is the returns that we can make. So we don't make them trying to get to a target weighting. We make them because the investments are there and we're confident we can make good returns. The exit markets have held up well, as I said, 47.8 million in the first half of the year, which is a very respectable number. If we extrapolate that for the full year, which I'm not sure is necessarily the right thing to do, that would lead to over 90 million of exits, which would be probably something like the second highest year we've had, or third highest year. It probably won't be quite as strong as that, but I think it will be pretty good. Obviously, the whole Russia-Ukraine inflation situation does present challenges for the companies, and you can imagine the discussions that are going on in the boardrooms of these companies at the moment. Supply chain management is taking out quite a lot of time. I think a number of them will be focused on the energy situation. It's obviously not. It's not a good situation, but some of the companies, as I mentioned, actually do benefit where they're in the energy sector. Others can mitigate and adapt. Others will suffer. I think we'll see a bit of a slowdown in activity in the second half of the year. I'd expected some of that by now. I think there'll be a bit more of a slowdown. I don't think we'll see a sort of massive collapse in activity or anything like that. And I think we'll continue to see realizations being achieved as we do on a sort of weekly basis. We are seeing, good exits taking place, and there will be good deal flow, and much of it will be, better priced than it would have been a few months ago. There is a long-term appetite for private equity. You can see that in terms of the money allocated to new private equity funds, and that is based upon the long-term track record of the asset class through different economic cycles. There is a sort of highly interventionist model of investment here where lead managers can be involved and help the businesses. That model was very well vindicated during the pandemic and has been in previous crises, and I expect it will continue to be well vindicated as we go forward. So I think there's every reason to be cautiously optimistic about the future from here. So I'm going to stop the formal presentation now and hand over to Paul, who's going to open up on the Q&A.
Fantastic, Hamish. Thank you very much indeed for the presentation. As Hamish said, ladies and gentlemen, do please continue to submit your questions using that Q&A tab just situated on the right-hand corner of your screen. But just a reminder that recording the presentation along with a copy of the slides and the published Q&A can be accessed via your investor dashboard post this presentation. Hamish, as you can see, you've had quite a few questions come through, so I will start with some of these and we'll pick those out. Right. The first one we've got here really relates around to the debt. I think we touched on that on slide 10. As we approach a high interest rate environment, can you detail the profile of the debt within the portfolio, floating, fixed, revolving credit facility, etc.?
Yeah, so the two levels of debt. So there's the debt in the underlying companies. So most of these are management buyouts, so they will have debt to some degree. So mostly it would be floating. They will have a margin over LIBOR or SONIA or whatever the current benchmark rate is. Sometimes there'll be a bit of fixed, but I would think the general assumption would be that it is floating rate debt. I think I know what's behind the question is what will happen if the interest rates go up substantially. Well, that is something that most experienced private equity managers have been expecting for years, and they will have stress tested and modeled to make sure that under all foreseeable circumstances, short of a disaster, they will be able to service and repay the debt, even if interest rates go up. The people that are doing these deals started their careers paying, in some cases, double-digit interest rates for debt, and so they have never assumed that debt would be as cheap as it has been, and are prepared for it to be more expensive. So I'm not expecting there to be a sort of rash of defaults and disasters. I mean, there may be some, but I don't think there'll be lots of those. And then looking at our debt, so we have two elements to our debt. There's a term loan, which is 25 million euros, and that also has a floating rate. And then we have 95 million pounds revolving credit facility on top of that. Again, that's on a floating rate. There's a fixed margin over LIBOR in that case. Obviously we take into account not just the rate when we put it in place, but what it's likely to be going forward. Now, obviously, when we put it in place, the base rates are very low. The margin is significantly higher than the base rates even now, and that will probably continue to be the case. So we believe in the benefits of gearing because we expect the returns that we'll make will be far in excess of the cost of gearing, even under a significantly higher interest rate environment. And that enhances returns for shareholders.
Thank you, Hamish. Another question we've got here is great to hear the success stories, but how do you monitor the investments which may be flagging or possibly not going to thrive, and do you sometimes pull the plug?
Yeah, so I mean, obviously, there are always some things that are below plan. So this is about getting the information, asking the right questions. In extremis, ourselves and the lead managers. Now, bear in mind that we're not the lead manager in any of these co-investments, but we have a say on things. In extremis, they'll look at things like changing management, and that does happen. I mean, that's one of the things you can do as a private equity investor, which is difficult to do as a public company investor. But that's generally a sort of last resort. So it's all about being, constructive, getting the information, trying to provide strategic help, which in some companies is easier than others, because we are not, specialists in these areas, but we have seen lots of situations, so we can usually help there. In terms of pulling the plug, I think normally that you get to a situation where you're asked to put new money into the deal, and at that point you have to decide, are you going to put good money after bad or not? It could be good money after bad, or it could be money that will save the company, and that's a judgment that we make all the time. And again, that's all about information, risk, all that sort of thing. And sometimes we have to say, unfortunately, we're not putting any more money in, and that business may fail as a consequence. We always try and be as constructive as possible. If there's a route out that protects jobs and livelihoods, we'll always take that rather than try and sort of be sort of really kind of aggressive about things.
Thank you, Hamish. Next question we've got here is what are exactly other cash inflows? Is that recaps and underlying companies that flow back to investors in these companies, and why have they increased significantly in the second half 21 and first half 22?
Right, that would be. I think that was on the distribution chart, was it? Yeah. Well, actually, they haven't. I think you're mixing up the colours there. The other cash inflows on pages on slide 20. This was money that was. This is back. The other cash inflows actually relate only to 2006. So this was where we did a merger with the Discovery Trust, and essentially they had a small cap portfolio that was sold down, and then we got the money. So that's what that reflects. So actually, the thing that you're talking about in 2021, 2022. Those are co-investments being made.
Fantastic.
Okay.
We've got a few questions on your co-investments. What's the rationale behind why you're so keen on co-investments? How do you access the co-investments? And why do GPs give you access? What's their incentive? Do you have a longer holding period for co-investments? So quite a
Yeah.
few questions there, but
Yeah.
just
So why
looking
do we
back
do
on the
that?
process.
So quickly, the co-investments. First of all, we can see the deal. So we have access to all the information that the lead manager has. So there's no blind pool risk in doing a co-investment. Now we're fine with taking blind pool risk, but where you can avoid it, that is even better. So we can choose those investments. So we have our own investment committee that we do our own investment paper, and so we're exercising our own judgment on that. And generally that judgment has proven to be more positive than negative, actually, and so it does help returns. Secondly, the economics are generally better than they would be if you're in a fund. So either sometimes there's no fees and carry on the co-investment, but usually there is some fees and carry, but they're at a lower level than would be the case in a fund. And so that, all things being equal, enhances the returns. And in fact, if you look at the overall returns between co-investments, or compare the returns from co-investments to those from funds over the long term, we are several percentage points better in co-investments. So that is why we believe in having a significant exposure there. Why do the lead managers give us these co-investments? Well, first of all, sometimes they're doing deals that are their unit size is too large for their fund, and so they want to do the deal, and so they will have some excess, if you like, and they will come to us as a known co-investor and a friend and ally of them, and ask us to do the investment. So that's one of the uh, most common reasons. Sometimes the managers don't have an active fund of their own at the moment. They may not have raised a fund. They might be a new firm, or they might be between funds, and so they need co-investors. Why do they choose us? Well, they basically know us because we've been in the market for a long time. We've probably backed them. We've probably backed the individuals involved either in that firm or in other firms. They know that we can provide the capital, they know that we understand the risks, that we know how to behave in the deal, that we will support them in the deal, and that we are sort of well-informed, sensible capital, if you like. And once you have a reputation for being a good co-investor, then you tend to get plenty of opportunities to co-invest. So it's a big part of our strategy. We have done 100 co-investments in the European mid-market since 2003, which is more than most of our competitors. I think quite comfortably can say that. So we are experienced in this, and we spend a lot of time on it. I think that covers most of the bits of that question.
Fantastic, thank you. Next question we have got here is, where are we? I beg your pardon. I think we've just covered that one off. You mentioned you can buy secondaries at 50% discount to NAV. Would you mind elaborating on this, and how do you source them? Why are sellers selling? Why not do more?
Yeah, so that one specifically was quite a special situation in that we were essentially buying the rump position in a fund that we manage ourselves. Now, obviously, we had to establish that that price was a fair price for all concerned, and we did that by doing a market testing exercise using a consultant in the secondary market, essentially finding another bidder that would have paid that price, so that we could be sure that that was a fair price both for the seller and the buyer, which is extremely important to me because I manage both those funds, and I would not have dealt had we not been able to prove that robustly. In fact, I wouldn't have been allowed to by either the buyer or the seller, or indeed my colleagues internally. So normally you wouldn't get in at such a deep discount because that was quite an old portfolio with not very many assets. Conventionally, you would normally pay a discount to NAV because the the people are the vendor need liquidity. Now, why are they selling? Sometimes they're changing their balance of their portfolio. Sometimes they've run out of money. Sometimes they shouldn't have invested in the first place. They didn't understand what they were buying. There are quite a range of motivations, but in every case, they are a motivated seller, which means that if we have we as a buyer have a bit of an advantage there. We model the portfolio in detail. We work out what price we would have to pay in order to make our target return, which is a 25% net IRR minimum. And that normally involves paying a discount to NAV. And I would say, we model this and then we come up and say, well, this is the price that we'll bid, and it's normally quite a big discount to NAV. And I often think, well, the vendor is never going to accept that. It's far too low a price. But you'd be surprised, in a significant minority of cases, they will accept it because they, as I mentioned, they are a motivated seller, and that tends to be a good deal for us as the buyer. There's a big stock of private equity held internationally now, and as a consequence of that, there is a steady flow of people deciding to exit prematurely, if you like, into the secondaries market, and we're there to buy those assets.
That's great, thank you. Next question we've got here: what do you attribute the current level of the share price discount? Do you expect the discount to NAV to narrow anytime soon? And I think there was a couple of questions around that.
Yeah. So obviously the discount is wide. It's in the the 30s at the moment, and in that respect, we're no different than anybody else in our sector. It's extremely frustrating because I don't think it fully reflects the value of the assets. Private equity investment trusts, unfortunately, have tended to trade at a discount to NAV. Not always, but generally. We value every quarter. There's a rigorous valuation policy. You can test the efficacy of the valuation policy by looking at the price of the exits, and we had a lot of exits last year, and those exits were at something like a 35% premium to the immediately previous NAV before they were exited. So that tends to prove that the valuation methodology is fine. You would expect there to be an uplift from an unlisted valuation to a full realization where you're getting cash or some form of marketable security. So it is frustrating that the market doesn't fully recognize that, despite the evidence in front of its eyes. What tends to happen is that when the market goes into a kind of risk off mode, the discounts in our sector tend to widen out. And then when it's in a sort of risk on mode, when they've got a higher risk tolerance, then the discounts narrow, and they can narrow quite dramatically. It's all about supply and demand for the shares. The only solution is for me to encourage more demand for the shares than there is supply. I think we've got a good story to tell. We've got an excellent long-term track record. I think we're well positioned at the moment. We have got a wide discount. Some of our directors were buying stock not that long ago at well above this price, and the discount will narrow. When will it start narrowing? I don't know. If I knew that, I'd be a genius. But I think if you look at the long-term record at these levels, the discount does appear to be anomalously wide.
Fantastic. We've got a question here. Does the Ashtead holding at 11.2 million, 2.3%, reflect the recent sale in July by the PE firm at £2?
It will be based on the price at the 30th of June, which I don't actually have directly to hand.
We can always pop that response back as
I could find that. If you just continue with the next questions,
multitasking. Thank you.
I'll see if I can find that number from my file here.
We've got one here. Is your healthcare exposure spread over all types of company, trial stage, devices, biotech, hospitals, etc.? And do you invest directly or through specialist managers?
So the answer to that is yes, it is spread across all those all those different types, and we invest directly alongside specialist managers. So people like MVM, you've seen in the presentation, they specialize in that. Others like Apposite also specialize. So we've done a number of co-investments with them, but we also invest in their funds. So the answer is that we do invest in all that range of different types of healthcare company, and we invest both in funds and directly, always with an expert with us, because it's a sector that if you don't know what you're, if you're not an expert, I just wouldn't, or you're not in the company of an expert, I wouldn't get involved.
I guess one more just before we're coming up to the close. Well, perhaps you can see if you can find that number. A bit more of a generic question, really. Just talking about deal flow. What's that current deal flow situation like? I know we've touched on it in a couple of points here, but just to give the attendees a bit of a flavour.
Deal flow is good. I mean, any given point in time, we're seeing lots of opportunities. I mean, obviously, we don't, most of them we don't do. I mean, in co-investments, for example, we will typically reject about 90% of the 90% of the sort of fully packaged opportunities we see. So in other words, we're doing about 1 in 10 of them, and that will fluctuate a little bit. Sometimes a bit more, sometimes a bit less. And I think we haven't really seen any kind of lessening of deal flow. I thought we would have seen a softer deal flow picture by now. I mean, it may be that it just hasn't happened. So, like all investment managers, we spend most of our time looking at things and deciding not to proceed, and then doing a small subset of the opportunities and taking them forward and dealing.
That's fantastic. I think we just are coming up to that hour, so thank you very much. I know you have addressed cracking an awful lot of the questions we've had through, and if there are any further questions, you will have the opportunity to respond to those. We'll publish responses where appropriate to do so on the Investor Meet Company platform. Hamish, perhaps before redirecting investors to provide you with their feedback, which I know is important to you and the team, if I could just ask you for a few closing comments, please.
Yes, I think private equity has had an interesting couple of years. We have gone through the COVID-19 pandemic along with everybody else, but it has proved to be resilient. We've now got a fresh set of challenges with the economic environment, inflation, supply chain issues, the implications of the war in Ukraine. The private equity model does allow the lead managers to involve themselves in the underlying companies and to help companies. And this has proven to be highly beneficial through all sorts of previous crises. We have a very well diversified portfolio, and that combination of the interventionist model, the alignment of interest, and diversification, I think will stand us in good stead. So I think there's every reason for people to be confident that they'll be able to continue to make good money from investing in our company in the second half of this year and into the longer term. Thank you very much, everybody, for your interest, and I look forward to catching up with some of you or all of you in due course.
That's fantastic. Hamish, thanks again for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Good morning to you all.